The United States Letter Carriers Mutual Benefit Association offers the MBA paid up at age 90 whole life insurance plan to NALC members and their families. A whole life insurance policy provides protection for an individual's entire lifetime. The amount of insurance of the policy never changes. The premiums on the policy will never increase or decrease during the premium paying period. This policy can be issued to any applicant between the ages of 0 and 70. Premiums are paid from the beginning of the policy until the policy anniversary date after the covered insured turns age 90. After that time, the policy is fully paid up and no further premiums will ever be due. However, the valuable life insurance will remain in force. This plan of insurance is particularly good for members who want a more affordable premium payment. NALC members can apply for a policy for themselves, their spouse, children, stepchildren, grandchildren, step-grandchildren, great-grandchildren, and step-great-grandchildren. The face value of any whole life policy can be for any amount between $1,000 and $100,000. Part of every premium payment on a whole life insurance policy goes toward building a cash value. This cash value increases according to a preset schedule. Because the whole life policies have a cash value, the owner of the policy has the ability to borrow against that cash value. The interest charged on an MBA whole life insurance policy loan is very low. The premiums on an MBA paid up at age 90 whole life insurance policy must be paid for the entire premium paying period. If the owner of a whole life policy is unable to continue the premium payments, there are options built into the policy to avoid cancellation. These are called non-forfeiture options. The two non-forfeiture options are extended term insurance and reduced paid-up insurance. Both options use the cash value of the policy that has accrued over time to purchase insurance coverage. The extended term insurance would allow the policy owner to keep the same amount of life insurance. However, the insurance would only last for a certain period of time. The reduced paid-up insurance would reduce the amount of insurance. However, the insurance would remain in force until the covered individual's 100th birthday. Premiums may be paid directly to the MBA's executive office annually or monthly 12 times per year. Or the NALC member may choose to pay premiums through the convenience of biweekly payroll deduction. The policy owner may change the frequency of premium payments by contacting the MBA office. The policy has a 31-day grace period for the payment of all premiums. This means that if a premium is not paid on the due date, the grace period begins. During this period, the policy remains in force. If the insured dies during the grace period, the amount of any unpaid premium shall be deducted from the proceeds. If the premiums are not paid at the end of the grace period and the policy has a net surrender value, the extended term insurance provision will be applied. On an annual basis, the Board of Trustees determined if the whole life policies will share in the operational surplus accruing from participating policies. This share, if any, is called a dividend and is credited to the policy on the policy anniversary date. The policy owner has the following options to receive the dividends on any whole life policy. Left on deposit at interest, never less than 2%, paid in cash, used to pay premium on the policy, or used to purchase paid-up additional life insurance. Dividends may be withdrawn at any time by the policy owner by sending a written request to the executive office. The owner of a policy is the only person who may exercise all the rights and privileges contained in the policy. This includes the right to change ownership. The owner may transfer ownership at any time during the insured's lifetime. To make a transfer, the MBA must receive written notification at our executive office. A whole life policy will terminate upon the written request from the policy owner to our executive office, when the insured dies, when any indebtedness exceeds the surrender value of the policy, if the policy lapses and there is no net surrender value, or at the end of any extended term insurance period.